Hey there, I am John Stevenson and your host of the Guaranteed Retirement Guys Show. Today we're going to be talking about maximizing the tax-deferred growth of any account. Okay, so if you're looking to get as much growth as possible, usually if you have it grow in an account where it's tax deferred, letting it accumulate over time, letting the compound interest do its thing, then usually that's the best way to grow wealth. I would say most people would agree with me there because they would rather not pay taxes every single year, like maybe a CD, and they would rather compound the growth. So here's the thing though, if you put it tax deferred, as you know, you're going to be paying taxes later on, because if Uncle Sam's going to give you if they're going to give you a break now, okay, they're going to let you deduct your contributions right now, then of course they're going to make you pay for it later, because you're going to have to pay usually ordinary income tax on that plus all of the earnings. But it's still usually the best way to go. If you want to grow wealth and you want to compound it, tax deferred is the way to go. Now with Roth IRAs, the nice thing about those is, yes, you are taxed on the contribution, so it's already after tax dollars, but if you put that in here and you let it grow, whatever growth it has will grow. I would say tax deferred, but it'll compound deferred growth that will be taken out later on completely tax free. Okay, so if you have an IRA, a 401k, and it's already tax deferred, you can still get tax free, but you have to be willing to convert it to a Roth. So a lot of people don't want to do that. It just depends on your tax bracket. Sometimes it makes sense, sometimes it doesn't. And you can do that with annuities. You can convert them, while after you fund the annuity, you can convert it to a Roth if you so choose. So anyways, we can talk about that. If you want to chat about annuities, just book a call. You'll notice there's a link below this video. So, all right, so I'm going to share my screen and I want you to see kind of what this does. If you're looking to maximize, and we're just going to look at some MIGAs right now. MIGAs are multi-year guaranteed annuities. They basically provide a set interest rate. They're very popular right now just because interest rates are so high. But again, at the same time, if you're looking for guaranteed income, they're usually not the best. If you're looking for guaranteed income, a fixed index annuity with an income rider is usually the way to go because you get a whole lot more for it. But let's look at this. So 5 years, 6 years, I just put all the way up to 10 years just so you can see what the rates are. But let's look at how this compounds. All right, so I'm going to go into American Life. Let's just see how this compounds. We'll just look at $100,000. Just make it easy. Okay, so here's what's cool about this. You notice that the earnings is $5,734 the first year. But of course, the year after that, it's $6,000. How does that happen? Well, it's just because it's compounded. Now, instead of $100,000 earning that 5.7, now you got $112,000 earning it. And this is, let's see, 5.7 compound interest, guaranteed yield to surrender 5.8. So it's a little different than just some of the other annuities where it just pays the same interest every year. But still, a guaranteed yield to surrender at 5.82 is pretty good, which is showing a guaranteed ending value of $132,731. So if you're looking for a lot of growth, a lot of compounding, this is the way to go. Because you can notice at the end of 5 years, you've got $125,573 earning that 5.7 interest rate, and that's earning $7,158 for the last contract year. Now, let's say you want to extend this. Maybe 5 years is not long enough. And here, let me go in here and let's just say we only want to look at A-rated companies. Okay, that's fine. So A-rated company, the highest one for 7 years is ClearSpring. So we'll go in here and say, okay, well, we want 7 years. We don't want 10, it's too long. 5 is too short. We want to lock it in longer. And so this is what we could do. And the compound interest is 5.45, and it's compounding every single year. So at the end of 7 years, the guaranteed ending value is roughly $145,000. Pretty good. Anyways, you can see the first year it's earning $54.50 because it's earning that 5.45. But then, of course, the compounding, and this is when you're talking about maximizing your deferred gains. This is how to maximize it. You're deferring it, and every single year you're letting those gains stack on top of each other. So all the new interest is earning interest as well as your principal. So at the end of, let's see, year 2, you've got 111,000 earning 5.45, and now that earns 6,000. You fast forward all the way to 7 years, you've got 137,493 earning 5.45, and that is crediting your account 7493. That's pretty good. That's the power of compounding, and that's the power of deferring. Obviously, you could take this out if you want. I mean, I have people that will purchase annuities. You could put $1 million in here, and it'll give you $54,000 a year. But if you take that out every single year, of course, at the end of the let's say you did it for 7 years. At the end of the 7 years, you've taken that out, but you'll take your $1 million out at the end of these 7 years instead of the compounded growth than you could have had you just let it sit there and grow. So if you're thinking about maybe an alternative to CDs, this would probably be it, because CDs, you're required to pay that tax every single year. With an annuity, you're not. It is deferred. And I might add, it doesn't matter if it's an IRA or if it's coming straight from your cash checking account, your brokerage account, it is still tax deferred growth. So pretty cool. So obviously at the end of 7 years, let's say this money just came from your bank account. Normally, you'd have to pay taxes on that $45,000, but if you roll it into another annuity product, it actually will continue to tax defer, even if that money is non-qualified, from a bank or from a brokerage account. So that's good to know, because most of the time when people think tax deferred, they're thinking of qualified accounts like 401ks, IRAs, things like that. So pretty interesting. I wanted to share that with you so you can kind of see what that would do. I'll just do one more example. Let's look at the 10-year. This one's paying a 5.8, and this is with Royal Neighbors. Let's look at this. All right, guaranteed ending value, $176,567. Pretty good. And of course, if you want to take out the interest every year, you certainly could, but you'll notice that if you let it compound over the years, like the last year on the 9th year, it's $166,808 earning the 5.85, giving you $9,758 in interest the 10th year. That brings the grand total interest earned, tax deferred, at $76,567. Now, of course, if you took all of that out, you're going to be taxed on that growth, or you can just roll it over into something else. So, and continue to defer that. So, maximizing any type of growth. I don't care if it's stocks, bonds, mutual funds. If you have all of those inside of an IRA and they earn, you're going to have all of the growth and all the principal earning. And of course, that will compound over the years, which is going to give you a pretty big nest egg over time. But annuities are just, they are the tool that you can use if you want guarantees. Okay. If you don't want it in the market and you want guaranteed growth, that's pretty high, and you want it compounded, then annuities might be right up your alley. So anyway, so that makes sense. Go ahead and book a call. You'll notice there's a link below the video. We can chat. We can see what you're looking for. If you want help setting up an annuity, I can do that for you as well. Otherwise, don't worry about me trying to sell you anything. I would just be there to help you and answer your questions. So hope this helps, and we'll see you in the next video.